Hello, welcome to the ISRI financing session, using financing and recycling as a strategy to maximize growth. Thank you so much for joining us today. I'm Paula Summers Murphy. My company is Vision Financial Group. We are ISRI members and we provide equipment finance services to the recycling industry. Today we'll discuss how recycling companies utilize different methods of procurement to acquire the equipment they need, and how finance plays a critical role in how an organization manages their cash flow. We will talk about the different types of financing used by recycling companies, and we will also illustrate the importance of offering finance options in the sale of recycling equipment. Kevin Canepa, Director of Sales at VFG, will now discuss financing and recycling as a strategy to acquire equipment and the different methods available.
Hi, my name is Kevin Canepa. I'm from Vision Financial Group. I'm Director of Sales. I have been in the industry for about 25 years, in finance industry, doing specifically waste and recycling for the last 7. In that time, we've really grown Vision Financial Group's whole asset portfolio in waste and recycling to the point that now it is one of our largest business segments. Last year, we did over $40 million in financing for the waste and recycling industry. My goal here is to educate you on the different players in the market that you can provide you for financing, as well as tell you the different types of financing models that we currently have that are out there, different financing products. Nearly 79% of all U.S. companies use financing of some sort. In 2019, nearly $900 billion of assets were financed in the U.S. Financing is just not a product for those companies that are cash strapped, but they're also good for cash management, such as large companies do not like to use their money if they're buying forklifts, for instance, that they know that they're going to get rid of in 5 years, and they don't want to have to deal with the hassle of reselling that equipment on the used equipment market. A leasing company can take care of that for them. For the bean counters out there, equipment finance is often a way to manage your balance sheet. So your accountants out there might want to use leasing so that you're not bringing on assets onto your balance sheet. Used in conjunction with equity, senior debt, and other debt instruments, it's the most important way to manage your cash flow, manage your balance sheet, and manage your taxes. A little bit about a difference between a lease and a loan. A loan is a financing instrument that allows you to have possession of the equipment at the end and own title. It's a contingent title to make that happen. A lease can be that way, but it also can be a point where you do not have the tax depreciation, you do not own the asset, and you're only renting for the useful life of that asset, and then it's returned to the leasing company and they take care of it. What that does is that allows you to expense the full lease payment versus just expense and interest on, say, a loan. So there's different tax advantages because your net income will be lower if you're accounting for leases versus loans. There's many different ways you can obtain financing for your equipment. You can use banks, you can use captive finance companies, you can use independent finance companies, and you can use brokers. All 4 of them have their different strengths and weaknesses, but my goal is just to teach you a little bit about who are the players so that you know who to go after. Bank financing. Banks can finance, and they have a variety of different products for you. They're usually going to be your lowest price as far as interest rate, but the bad side is sometimes they're going to give you what's called bank covenants. They're going to have requirements in your financial statements that need you to meet certain criteria every year on your financials. And if you don't meet those financials, you're in violation. Now, that doesn't mean that they're going to call the loan. It just means that they're concerned about the way you're managing your business. So banks are going to get a little bit more closer into your business about what you're doing and how you're doing it, to make sure that their assets are covered. Plus, banks are also going to give you lines of credit, and do a lot of different multitude of things that some of your independents or your brokers cannot do. Captive finance companies are usually a arm of the manufacturer that will set up financing rates for their customers to sell more product. Sometimes those are very attractive rates, such as 0% interest, but they're being subsidized by the manufacturer. So your real interest rate could depend, because wherever there's time and there's money, there's interest. If they're giving you a 0% interest, someone's paying for that, and usually it's the manufacturer is paying their finance arm to discount those interest rates in order to get you the best deal possible. An independent leasing company has many attributes. Usually they have their own money. They'll finance. They can be generalist or they can be industry specific. There's a lot of different independents out there. The company I work for happens to be a niche market player. We like to specialize in our industry so that we know our assets and we know our customers and what types of problems they're having, and can give them a full solution. A generalist is more like, we'll take a one-off deal and make it work, and we'll figure out how to get it done for you. Sometimes there's small ticket independents, there's large ticket independents, and what they call small ticket versus large ticket depends on how big the company is. Sometimes yes, micro tickets are $10,000 and under, and someone will say we're a large ticket shop and they're only $1 million and above. But you can find many different independents out there, and there's very good quality ones out there. Brokers are people who work typically independently, and they go out and they work for the clients, and they find the right financing source. And they may go to a bank, they may go to an independent, they may go to a captive, trying to find the best rate for their customer. They get paid typically by the company that underwrites for them. So there is some cost there, but typically they can get you a good deal also. Why equipment finance? Countless reasons to do so. Obsolescence management, product service bundling, equipment disposal. Those are three of the major reasons to do what's called an FMV lease, and I'll go through that later. But you can conserve cash. It's 100% financing typically. There's a hedge against inflation, and you can improve your business planning. You can manage your business and not worry about capital expenditures, because you're paying monthly and you're earning the revenues to match those expenses on that equipment that you're purchasing. The main reason to equipment lease is to preserve valuable cash. Finance experts generally recommend that you have a cash reserve of 3 to 6 months, so that by having that, it demonstrates a financial stability. It allows you to hit bank covenants for liquidity ratios, financial statements, and it allows you to look at opportunity costs. Meaning, if I were to pay $300,000 for this car crusher today, what's the opportunity cost for not being able to have that cash versus leasing it and paying $10,000 a month? And finding out that you're matching your cash and revenues, and you're getting immediate cash return on your investment. The other thing to preserve your cash is for emergency, unexpected expenses such as breakdowns, things like that, decrease in revenue, market fluctuations, operational efficiency as far as paying bills easily and paying employees easily. Some of the benefits of equipment leasing: there's income tax implications where you can get 100% bonus depreciation. It's called Section 179. There's cash flow considerations such as You don't have to put out any down payment. You don't have to put out any cash up front. We finance 100%, and you pay as you're maximizing your revenues on that piece of equipment to the expenses. We can actually do sales leasebacks to generate cash. We've done that in the industry quite a bit, as far as financing someone's wanted to purchase land, for instance, to add to their scrap metal yard, and we've been able to refinance their equipment, give them the cash they needed so that they own the land that they're on. There are basically 4 types of leases that we work with. Finance lease, which is a buck-out lease. It's typically very much a transfer of ownership at the end, and what it does is it allows you to pay for the taxes over the rental payment versus paying for taxes up front and having to finance those taxes. There's we call an operating lease, which is a lease that allows you to purchase the equipment at the end for the fair market value. This is basically for utilizing assets that you may not want to purchase at the end, and you're willing to take that risk of what the fair market value will be 36, 48, 60 months from now. We also have what's called a track lease, and that's for basically titled vehicles across the board. And it's a clause that guarantees what that buyout rate would be, and you can return the equipment, but you're responsible for if we're not able to sell it for, say, if we took a 20% balloon and we were only able to sell it for 15%, you would come up with 5% and walk away from that lease. You could sell it for 25% and get the extra 5%. And then we also have a rental, which is very similar to an operating lease, but it doesn't allow for purchase at the end. If you're a vendor, using financing as a sales tool can really be valuable for your customers. The financing option will show them how their ROI is going to be immediate if they're matching revenues with expenses on a monthly basis. Customers like one-stop shopping. The reason why they like that is because they know that they're going to be able to pay for that equipment that they're already negotiating with you on purchasing. Financing options and offering them shortens the sales cycle, because that person doesn't have to figure out, all right, how am I going to pay for this and where am I going to go? And it also offers an additional tool to acquire your solution, which allows the decision makers to get quickly the information they need to make sure that they're making a sound decision. When you offer financing as a sales tool, typically the finance person's going to know a little bit more, because they're going to be told different information than what you're being told on where the process and where the deal is being done. One of those things is that they'll tell you that they're looking at competitors' equipment. Well, that finance guy is going to be loyal to you to try and find out where what is making that deal better than yours, so that you can talk and collaborate and come up with a better solution. When a finance person is talking to them, they're talking about long-term growth, and they can talk about other opportunities for selling into that entity. The lender, knowing the recycling industry is going to help, and knowing your product is going to help sell more product. What using a finance guy does is it quickly lets you know who's making those decisions, and that how many checks and balances are going to be to be able to sign off on your sale. Typically, there is always going to be an operations person and a finance person that are coming together to figure out, is this best for our company? And by bringing in a finance company, you're going to have the inside knowledge of where they're thinking and what they're thinking about your product.
Thank you, Kevin, for that fantastic overview. Now let's speak with Brandon Rosnowski, CFO of Premier Metal Buyers in Brenham, Texas. Premier Metal Buyers are also ISRI members and members of the Gulf Coast chapter. We'll speak to Brandon about how they utilize equipment financing as a strategy for operating their business. Hi, Brandon. Thanks for joining us today.
Hey, Paula. Glad to be here.
Thank you so much. Would you mind introducing yourself and telling us a little bit about Brandon Industrial Group?
Sure. Yes, my name is Brandon Rosnowski. I'm the CFO at Brandon Industrial Group. We operate our scrap yard under the DBA of Premier Metal Buyers. We have a yard in Brenham, Texas. That's kind of about 50 miles northwest of Houston, in between Houston and Austin. So we're a family-owned business, been around for about 10 years now. I think this is actually our 10th year, so we're celebrating that. And anyway, so we got a mixture of industrial accounts, commercial accounts, and certainly handle ferrous, non-ferrous. So do a little bit of it all. And each day, obviously, in the scrap business, we learn something new, and certainly have a lot of fun doing it.
So, Brandon, when you're considering capital sources, what are the most important characteristics you look for in a finance partner?
I mean, certainly competitive terms are important. However, in an industry that moves so quickly, speed and ease of business with a lender and their consistency outweighs necessarily shopping for the lowest interest rate on every deal. Just kind of for perspective, 25 basis points is only about $10 a month on a $100,000 loan over 5 years. So depending on the opportunity and circumstances, a small premium may be well worth getting a deal done faster. In our organization, we strive to forecast and plan our CapEx to the best we can. But with market fluctuations, business opportunities and challenges, that really forces us to be dynamic. So, you need a lender that can do that as well. And so knowing that your lending partner will be there for you consistency, to kind of cash the check that you wrote per se, and can do it timely is certainly a tremendous asset to a business.
How important is it for your lending partner to understand the recycling business?
I think it's very important. I'm being in the commodities business. There's a lot of inherent volatility, and we've encountered some lending folks that really like our story, find the operation exciting. There's a lot, like Paul mentioned, our yard gets busy and there's a lot of cool things happening. But then they get a little uneasy when they see our P&L. Occasionally looks like an EKG monitor. So just like other industries, metal recycling has its own set of nuances that make it tick. And if the lender understands them, it makes life a lot easier. Things go faster and smoother, and a lot less frustrating explaining everything. I firmly believe that having a lender that does not understand the ebbs and flows of the metal market considerably adds a risk to an organization. I mean, anyone can lend in an elevated commodity price or a kind of a cycle of strong cash flow generation, but when things get tight and you land a new account, you need a piece of equipment maybe to open up some margin or just need some liquidity to kind of bridge a little rough patch or elongated cash conversion cycle. It's imperative that you have someone who understands your business and the market to support you during those times.
So I think, in your business, it's important to have, multiple lending partners. You obviously have your banking relationship, and you also have third-party lenders that you likely work with. In what scenario do you use bank financing versus third-party financing?
Yeah. Well, first of all, we've been fortunate to build strong relationships with both groups and really do value them both. In our experiences, the third-party lenders have been able to kind of digest transactions and move on them quicker than the traditional bank underwriting process. Oftentimes, the third-party lenders aren't bound by structured lending policies that the banks have to maintain. And the third-party lenders have presented us with more creative and custom equipment financing options. Now, our banking relationships, those have primarily been with our community banks. I mean, we're in a small town, so the community banks are very active. And they've been instrumental to our growth by financing acquisitions, real estate deals, and some equipment. But we've been blessed to find great groups on both varieties that believe in us as a business and operators more so than just the collateral that they're lending on.
So to that end, it's probably a different type of structure that you're financing with your banks versus your third-party lenders. So when you do finance, what type of structure are you typically utilizing for different types of equipment? Are you're using leases, loans, rentals, and why?
Yeah. Well, we use a combination of all of them. Rentals are going to be a practical solution for projects and times when equipment is down. Lost production and opportunity costs can outweigh the elevated cost of that daily rental. So just being able to do it matters. Purchasing and maintaining too much backup equipment can be expensive and also promote inefficiencies on your yard. If you put an extra crane on the yard, and the guys are gonna build an operation around it whether they need it or not. So you really don't want to have too much additional backup equipment. So that's where kind of a rental kind of comes into play. In terms of leasing and buying, even though there's been some changes in taxes and tax appreciation and accounting rules that have kind of removed some of those historical advantages of leasing, we still do lease equipment. We, like most folks in our industry, with a lot of equipment, struggle to find quality mechanics and service techs. So some of the operating leases that we have actually provided a kind of a vehicle and a source to kind of outsource our fleet maintenance, that is, along with kind of forcing the lessor to keep the backup units as well and maintain those. We also contemplate the asset type in leasing versus owning. This business is very hard on equipment. It's a lot of metal on metal, dusty environment, and in our region, hot Texas summers. So just very difficult on equipment. And as we've matured as an organization, we've learned kind of the hard way a lot of times that equipment does have a finite life, and replacement plans are very important. So we actually probably prioritize really the structure of the financing, being in line with more of the asset life and kind of what do we have on the backside of that with the replacement strategy over necessarily a capital lease or a loan.
Well, that makes sense. And I'm sure, it makes sense to consider leasing for, vehicles or forklifts, perhaps, as opposed to, an asset that has a 25-year lifespan.
Right.
Well, I appreciate that insight, Brandon. And, there's also going to be times that you have a lot of cash on hand. So what kind of goes into your decision-making process if you're going to actually just spend cash for equipment as opposed to financing it?
Yeah, a combination of things come into play. As you mentioned, just having cash. So there's certain periods of the business cycle that are more fun than others, and you do have cash. So just physically having it, and then also kind of your projection of where you think you may be in the short or short term or intermediate term, knowing kind of cycles of your business, that certainly comes into play. Asset amount, there's direct and even hidden or indirect costs of getting financing and maintaining a loan. And so kind of for every organization, that threshold is going to be a little bit different. Asset type, some things are easier, more competitive to get financing than others. Titled assets versus something non-titled, such as an analytical gun or something like that.
Mm-hmm.
And then also, you want to kind of keep a balance of that of the asset value. So, and then what you owe on it, you don't want to necessarily be underwater. And so some assets depreciate faster than others. So, those items with shorter lives, you may be we're more inclined to go the cash route. Available interest rates, that's another one. In a historical context, we're in a very low interest rate market and environment. And so there's that coupled with dealers and manufacturers who are offering a lot of aggressive incentives, make it a pretty good time to borrow. So that another one, debt service ratio goals. So whether you're required by a lender covenant or it's just an internal goal, maintaining a healthy balance sheet is certainly important to the stability and longevity of an organization. No, I don't think inherently nobody really likes debt, but it's certainly a lot easier to sleep at night without that cloud hanging over you. But without a doubt, in this industry, cash is king, and so we definitely feel there's an art of balancing a healthy debt level and maintaining cash reserves for opportunities and certain uncertainties that you may encounter.
How about a couple of fun questions? What's the most interesting item on your yard right now?
Interesting item on the yard. Well, we've got a lot of good ones. I could probably look out the window back there and pick one out. Yeah, well, I don't know if it's interesting, but one of the most important items is our shear baler. So we're a processing yard. So we pride ourselves being able to take in unprocessed material and upgrade it and move it out timely and kind of get it to the spec of the mill. So that was kind of one of the key pieces of our yard that really kind of took us. We feel it kind of took us to the next level of rather than just kind of buying and selling scrap, but becoming that processing yard. So I'd go ahead and say that piece because that was kind of the next step for us.
Now, is that did you acquire that with a long-term financing option or?
Yeah, we did. That was going to be through a bank, and that we were able to get that one done with. So a little like you referenced, is a little longer term or longer life piece of equipment there. So we're a little bit more comfortable extending the terms, and so was the lender. And like you said, it's good to have a balance between those and have some different lending options. And so for that particular piece was with the bank and a little longer terms, as hopefully it lasts a long time.
Sure. Well, what's the most unique piece of scrap that you have on the yard?
We always get some good stuff. The other day we had an airplane come in, like a small airplane. That one was pretty neat. And then a small water tower or cistern. We had one of those set up in the kind of came in. So you never know what's gonna come through the gates. It's a lot of fun, and like I said, there's all kind of neat stuff that comes through there.
Well, thanks for your time today, Brandon. I really appreciate it, and hopefully we'll have a in-person convention soon, and we'll get to see you next time.
Yeah, thank you. Appreciate you having me, and certainly look forward to getting back out there and to the next live convention.
Absolutely. Well, thanks, Brandon. Now that we've spoken about some of the different methods utilized to acquire equipment in the recycling industry, we would like to touch briefly on the importance of equipment manufacturers offering finance options to their customers as a procurement tool. There are as wide a variety of types of equipment used in the recycling industry as there are types of companies, from copper choppers to material handlers to vehicles to shear balers and shredders. From privately owned fifth-generation yards to publicly traded companies with multiple locations across the country. Each likely has different equipment needs and different strategies for how they procure their equipment. Although many recycling companies may have their procurement method in place, as a recycling equipment manufacturer, it is imperative to be able to deliver not only a quality product, but a variety of solutions for your customer to acquire your product so that you can control the sale. If you are presenting a finance option along with your equipment quote and your competition is not, you have a clear advantage. Also, customers like one-stop shopping. As Kevin mentioned earlier, there are often captive finance companies that are set up to finance internally, such as Caterpillar or John Deere, for example. If your company does not have an internal finance option, it is important that you align yourself with a lender who can offer a variety of finance terms, who you trust referring your customers to, and who can help you close the sale. This lending partner needs to be able to offer multiple solutions to fit each individual customer's needs. Loan, capital lease, operating lease, rental, the different types of structures that we've discussed earlier. This lender also needs to understand the value of your equipment. The lender needs to have recycling industry knowledge. And the lender should know and understand how the use of your equipment will make your customer more profitable. Now let's hear from Vision Financial Group's Kevin Canepa and Bob DeTroia, an equipment sales executive from Sierra, about how he utilizes financing in his sales approach.
Welcome to ISRI, talking to Bob DeTroia from Sierra International. He has been one of our proponents for working with us on financing of equipment. We help him strategically place equipment. Do you want to introduce yourself a little bit, Bob?
Sure. I'm, like Kevin said, Bob DeTroia from Sierra. I cover the Northeast Territory, everything from Maryland to Buffalo to Maine. And we sell heavy equipment to the recycling industry.
How long have you been in the industry?
About 18 years now.
And why is offering a finance alternative important to you as a vendor?
Most customers that are out there definitely can't afford it on their own. And to have somebody like you or your company help out, I mean, they're not too inexpensive, let's put it that way.
So do a lot of your customers ask for financing options from you when you're talking to them?
I would say about 65% of the people do ask.
Tell me a little bit about your used equipment market, how you participate in that, and do you do the used equipment sales, and whether you actually offer financing on that used equipment also?
We definitely, if we could find any type of used equipment, we would sell it.
Do you ever include maintenance or installation costs with your product?
Yes, on certain items that we have, maintenance and installation is included.
And how does having a finance company familiar with your equipment help you?
It's unbelievable. I mean, it's tremendous help to have somebody that knows the industry. I mean, I get calls from some people and say, hey, you know, I do financing. And then they say, well, what type of equipment do you sell? And I tell them, and they ask you everything about it. Well, what does it do? That doesn't help your industry at all.
And what is the single most valued trait in a finance partner for you?
Honesty.
Okay.
Definite honesty.
Now, do you ever lose sales due to subpar credits, that haven't been done, and people want to buy but they can't afford it, or they can't get the credit?
A lot. A lot.
Well, tell me about your favorite credit story deal that was done.
I like them all as long as they go through. I'm happy.
Spoken like a true salesperson, right?
That's right. That's exactly right. Well, I mean, I've had a few people that had problems with their credit and stuff. But there was one guy in Pennsylvania that we had a real hard time with, and you know, each one of the salespeople has their own finance guy and everything else, and we were having problems. He had his own finance people too, and if it wasn't for people like you, we wouldn't be selling too many machines.
The whole thing about credit in this industry is that there's a lot of good credits out there too. There's tougher credits because sometimes there's the ebbs and flows of business. it's always about quality, character, like you mentioned, honesty, character,
Right.
integrity, longevity in the industry. Many of these have been generations after generation type businesses that might have come upon hard times and just need a little bit of a lift up to make their flow more efficient and make their margins better. I appreciate your time with us, Bob. Thank you so much. And now I'd like to speak with you with Mike Taranovich of Proterra Recycling Systems. Mike has been an industry representative for many years now, from everything from single stream recycling to baling for scrap metal. I'm hoping that you'll learn a little bit about the way vendors do approach using financing as a sales tool. All right. So first, Mike, could you introduce yourself to us?
Mike Taranovich, Proterra Recycling Systems.
Tell me a little bit about the industry you've been in, and how you've approached the waste and recycling market.
We manufacture and design complete recycling systems. And a lot of the times when I have meetings with customers, it's about building a system, adding automation. What are the benefits? So I construct what I call a profit benefit analysis sheet. And when I find out what my budget's going to be for that system, I call you and get pricing for financing so I can go to the customer with a complete turnkey quote with financing included. And when I do my analysis sheets, it shows labor savings, added revenues and profits from more recyclables that are being picked out of the system or claimed. And by offering the whole package, the discussion is very much more compacted to the point where there's everything right in front of the customer, including the financing. And a lot of the times, even my biggest customers like to use somebody like a Vision Financial to keep their bank credit facilities clean and available. And even if it's slightly more interest rate, another benefit is even speed. Most times I can get a deal approved quicker through Vision than my customers can do through their own bank on a term loan, things like that.
Tell me a little bit about the secondary market. Do you participate in your own used equipment, and whether they use equipment off lease? You sell equipment used off lease or trade in?
Sometimes, but another benefit too is I can offer operating leases, which with my waste guys is a very big deal because operating lease is 100% deductible on the payments, and it doesn't go on their books as long-term debt, which is a big deal for a lot of my waste guys who engage in some very large capital projects.
Do you include maintenance and installation costs with your product offerings?
Yes, we do. We offer extended warranties, maintenance programs, preventative maintenance programs, and we will oftentimes add that into the quote, and it can be financed too, along with our whole package.
Does having a finance company familiar with your equipment actually help you?
It's a huge plus. I've dealt with customer banks before that didn't have a clue what a cardboard screen was or a optical sorter, and it just really slows down the entire process. And by dealing with people who really have expertise in the market, I don't have to re-educate everybody I talk to every time, and that helps speed up the process as well.
What is the single most valued trait in having a financing partner?
The start of the relationship building, between my company and then building relationships with the customers. I've had many situations where my customers used Vision for their first project and then wanted to do another project or add equipment. The relationship's established, everybody knows everybody. And that's another way to expedite financing to do the second project or third project and so
on. Do you ever lose sales due to subpar credits?
once. It was a tough situation. Customer recently filed for bankruptcy, but for the most part, even when we've had subpar customers, and you found a way to get it done.
Tell me about your favorite success story with finance.
There's a lot of them. Well, for example, Green Mattress Recycling. They were a startup, been in business less than 6 months. They needed a baler to bring their business to the next level. Couldn't get anybody else to even talk to them because they had so few months of books on record, and you were able to get the baler financed, and happened quicker than we even expected. And now he's grown his company exponentially and looking at other components to add, and
Well, thanks, man. That's all I had for my questions. I really appreciate your time, Mike. Mike from Proterra Systems. Thank you for doing that.
all right.
Thank you so much for joining us today. We hope that this has been an informative and educational session. We've provided an outline of some of the topics that we've discussed today for your future use. And remember, the different types of finance structures that are available to you can really make an impact on how your business grows and thrives. We hope you've had a wonderful ISRI 2021 convention, that you continue to reap the benefits of your membership, and that you continue to utilize the wonderful resources of this fantastic recycling community. Thank you.